I think I give probably over 50% of credit to Twitter on this whole business idea of launching. The reason is over time I developed enough of a following where I could ask a question and I got some good feedback. You know how Twitter goes. Like you get some really negative feedback, you get some overly positive feedback, but then like the stuff in the middle is like what's actually helpful.
People always ask that question, like, if you had to start back today and all you had was $500 in your bank account, like, what would you do? And my answer is, I'm like, consulting. It's always consulting. It's the closest thing that there is to speaking, words into money. And if you have valuable knowledge, like, that's important. Like, you can add value to folks.
So the only red flag that I've published is the word guaranteed. Which was honestly shocking to me, Max. Sometimes it comes from like what I would consider pretty either large or somewhat sophisticated sponsors. I don't think you should be investing based on macro events, right? Like that's to me, that's sort of like macro investing, not real estate investing. There's been this like obsession with reporting. Like you have to report monthly or weekly in some cases. I've even seen. And it's like you need to let the GP do their job. I also say usually it's really high highs, but really low lows, right? Because everything is personal. So I think that goes for the positives and the negatives. It's been pretty rewarding. It's been pretty stressful. It's been nothing like I expected when I was at a W2. It's way more complex than I ever thought it would be.
My name's Max Gagliardi, and this is Always Be Building. If you're watching this video, take a moment, hit the subscribe button on YouTube, or you can follow me on your favorite podcast app. Hope you enjoy the show. Aleksey, welcome to the podcast. Thanks for coming on.
Thanks for having me, man.
I think of you as the LP Whisperer is like my nickname that I have for you. I haven't trademarked that, so if you want to use it, you can. But like a lot of guests on here, follow you on Twitter and see the content that you put out. You're doing a lot of cool things and interesting stuff to me, helping out LPs in the real estate investment space. And so for those that don't know you, just start off with a little bit who you are and what you got going on.
Yeah, thank you so much. Again, thanks again for having me. Background at a high level is did a few different types of investing things. Started in the quant trading world, did a little bit of value investing, distressed debt, and then found myself in real estate when I moved to Phoenix. Worked for a public REIT, real estate investment trust, called Centrio Capital. Led the underwriting team there and the property portfolio management team. By the time I left, we had close to 3,000 properties that were all kind of folding up to me. Um, and yeah, at some point, I just wanted to take a risk and build something on my own. It's been pretty interesting 2.5 years. In the past 9 months, that's really when this new venture took off. Still very much building, still very much learning, but it's been pretty fascinating. So, just to summarize for those folks that don't know me, today I advise LPs, limited partners in existing transactions or future transactions. So you might be considering a new deal, and you might hire me to give you feedback, or you are already in a deal and perhaps there are some challenges or a decision to be made, and you want some independent feedback on how to think through it.
Yeah, I think this is something that it's interesting because I've looked at a lot of real estate deals. We have a real estate small little fund. We've done raised capital, not just in real estate, but in other areas as well. And it can be tough even for somebody that knows kind of what they're doing, even somebody that's been in the space for a while, to be able to screen deals, to be able to see kind of what's what. I mean, you hear a lot about even really sophisticated investors getting burned on things. So I think what you're doing is a valuable service. How did you get to that idea, right? You said you wanted to maybe do something on your own. Was that the initial thesis or like what kind of led you to that?
No, I tried a few different things, including cold calls when I was 32, I think, or something like that. I tried a few different things. Look, at some point, I realized that I needed the cash flow. I have a family, so that became pretty important. And a few ideas kind of fell into my lap, one of which would be obviously to get another job. But I tried to see if I could do something myself. The way that the idea kind of stared at me in the face, so to speak, is I got some decks from people. So like attorneys, software developers, friends of mine that would send me a deck and they would be like, "Hey, I'm thinking about investing a few hundred grand. Seems like a great opportunity. What do you think?" Right. So I would give them feedback, and I kept noticing the same trend. Like they didn't know what a cap rate was. Most of them assumed that like real estate can only go up. Most of them assumed that the worst thing that can happen is you get your money back, right? So there was just this um, consistency in the types of people that would invest a few hundred grand yet knew very little about how to understand or even the basics of real estate investing. And so that made me realize that there's something here. And, I did some more digging, and I guess at a very high level, this is a massive marketplace where retail investors alone like deploy billions of dollars a year across obviously like much smaller check sizes than institutional. And I don't know what percent, but certainly a decent percent of them uh, don't totally know what they're doing, right? And that I really liked education and teaching back in the day, so that like attracted me to the space. And I'm 9 months in, and so far so good.
And you've really used like social media, right? I mean, like you've grown a following on Twitter, now X. And I
Right.
think has that been kind of the main catalyst for like business development and like meeting folks and getting it out there? Or was it like started with your personal network and then you brought it to like the masses?
Um, I think I give probably over 50% of credit to Twitter on this whole business idea launching. The reason is over time I developed enough of a following where I could ask a question and I got some good feedback. You know how Twitter goes. Like you get some really negative feedback, you get some overly positive feedback, but then like the stuff in the middle is like what's actually helpful. And so I think it was maybe July of last year when I just tweeted randomly, like I gave someone feedback on a deck for free, and they were like, "Man, maybe you should do this. Like maybe you should charge. I would pay you give to give me feedback like that." And I was like, "Oh, maybe I should." So I tweeted about that, and I just said like, "Why isn't there someone that gives independent feedback on a deck for a grand?" Um, and that went somewhat viral, and there was like a bunch of feedback, and I was like, oh, maybe this is a real idea. you know and then throughout my journey, um I mean, I can tell you as of today, probably 60 to 70% of my revenue comes from either Twitter or LinkedIn leads. I don't really advertise. I just post ideas that I hope are helpful, and over time people reach out.
Yeah. What other are there any other groups that are in kind of this space? The only thing I can really think about in my mind that I've come across that's like this is if you have like a private wealth advisor or somebody that's with a large institution, a lot of times they'll kind of tout this as one of the services that they provide. It's like, hey, we show our clients private deals, we help them kind of vet them, give them feedback on if we think it's good or not. But outside of that, like I mean, maybe I just don't know, but like, what's the closest thing to what you're doing that you know of?
Yeah, so I mean, I think we can go sort of across the spectrum of capital. If you go to like all the way up to pension fund money and those types of checks, there are firms that do my type of work.
Right.
Then you go down to sort of like under $1 billion in wealth, where people are going to like either they have like a smaller family office, or they just have like a private net worth person. So as you pointed out, a lot of the private advisors will say that they help on those deals. But I found, at least, I mean, this is just my experience, and I could be totally wrong. I'm still learning a lot about the marketplace, but I've found a lot of those advisors to not know much about real estate investing.
Hmm.
And beyond that, you could also argue that some of them are incentivized, to keep investments in certain areas where they get fees and whatever, right? It depends on how their model is,
Right.
what the person is paying for. But yeah, and then as you go down to sort of like, I don't know, a software engineer who's worth $5 million looking to place $100,000. As far as I know, there's nobody that does that. I haven't. I mean, I've run into a few people that do it. Some of them have started after me. A few of them have been doing it before me. But it's like I can count all of them on one hand. And if anything, I think that's awesome. Like this market in my mind is so massive. Like there could be like 50 competitors, and there's still like plenty of people to talk to.
Yeah. Well, I guess you're right. I mean, at bigger deal sizes, bigger check sizes, I'm sure there's like companies that specialize in this, I would think, that do diligence, that come in and help underwrite projects. They've probably got multifaceted people on staff looking at capex, looking at different things, that can help underwrite it. But like at the size that you're doing it at, it's I think it's an underserved. I think it's an underserved space, and you see so many private deals get floated around, and it reminds me a lot of like how I started entrepreneurship, which was doing like consulting. And I worked for a big company similar to you. And then I had left. And then I found that a lot of the small and mid sized companies didn't really have my expertise for my specific niche. And so it was just like kind of consulting at first, and then we figured out how to scale that into a business. But I love people always ask that question, like, if you had to start back today and all you had was $500 in your bank account, like what would you do? And my answer is like, I'm like consulting. It's always consulting. It's the closest thing that there is to speaking, words into money. And if you have valuable knowledge, like that's important. Like you can add value to folks. And so I think what you're doing is smart. Are you surprised at how many people go out and put fairly large sums of money into these deals without really vetting it through either somebody like you or anybody that has experience?
Um, I think surprise would be an understatement. Um, and I suppose you could say that I'm biased, right? Because that's how I earn revenue. But a lot of what I see just doesn't make sense to me, right? Just like the entire premise on the business for me was, if I'm investing 100 grand, investing $1,000 into a review, or even 5 times that, in my opinion, would be a no brainer, because many times you're paying much more in fees, acquisition fees, other fees, and whatever. And so, um, once you invest, you don't really have much say, right? And to me, I guess I recognize the fact that I don't know everything, right? And so it's very valuable, at least once, to try an independent opinion to see, like, do they have anything of value that I didn't think about. But yeah, I mean, Max, I speak to people all the time that are dropping, in some cases, multi-million-dollar checks, and they just have like an aversion to either ask other people for their thoughts, um, or perhaps they don't value my thoughts, which is also okay. But um, a lot of them ask for like discounts, and I never give them, because it's just like it's such a crazy concept to me. But it happens. I probably happens once a week.
Yeah, I could see that. Everybody wants to discount, and in any type of business that you're in. Um, it seems like a small insurance policy to pay. Like I had a deal come across my desk the other day, and I was like, I just hit you up, and I didn't end up getting that serious about it. But had I seriously considered putting capital into it, I would have for sure brought you to look at it. Just because, I mean, there's different things. One is just having somebody else's perspective and someone else's eyes on it, and then I'm sure, like with the reps that you're getting now, there's got to be some pattern recognition for things like
Yeah.
red flags or misalignment, and we'll dig into these topics. But are you starting to see, is it getting easier to where now you're kind of like, there's almost like a formula to it?
To an extent. I mean, investing is, I think it can be, not automated, but it can be simplified, right? And so that's what I've tried to do in my writing, and the structure that I sort of deliver these reports in. Um, but it's still pretty complex, Max. At the end of the day, like no investment is perfect. No investment is going to be risk free or anywhere near it, right? And some aspects of a deal, for example, you might find something that has higher than market fees, but you're okay with that because of X, Y, and Z factor that you noticed. Or maybe the split is not market, but again, perhaps the GP has been around for 10 years and they've done a really good job, or maybe they've been around for 20 years and everything else looks really good. And you're just like, listen, I'm okay paying a little bit more, and I trust that sponsor. So it's a complicated thing, but over time, it's not just the reps that have been valuable. I think maybe the most valuable thing I've been getting together over time is a database. So like sometimes someone will reach out to me um, about a deal, a new deal, and I know several LPs that are invested in that sponsors other deals. And some of them I've advised on like capital calls, and some of them had foreclosures happen. And then you look at the deck, the new deck, and like it um, happens to, let's say, exclude the deal that had a foreclosure. And you're like, oh, that's interesting. You know, it's interesting
Yeah.
that you decided to exclude that one. Or perhaps that's the most extreme case I've seen. But in some cases, the deal will be there, and it's like months away from foreclosure, and even the GP has recognized that. But like, there's like some amazing valuation on it in this new deck, as if like you're
Yeah.
still gonna 2x your money, and you're just like, oh, that's interesting. Like, not so honest. And of course, like my job in this whole thing, or the way I view it at least, is to just give as much information as possible to create like a less um, inefficient market between a GP and an LP. And then obviously the LP can decide what they want to do with that information.
Well, it seems like you just want people to be eyes wide open going into a
Yeah,
deal and making sure
exactly.
that they're at a minimum asking the right questions and understand at least the best that you can the risks involved, as well as just the structure. Like you mentioned, is it market? Is it not?
Yep.
And then any other type of info or dirt, for lack of a better word, that you could dig up on a sponsor that since you've seen potentially the same sponsor multiple times. What are some like red flags or things that just stick out to you, that would just be like obvious things when you're looking at a deck and you're like, okay, this is like you immediately gravitate towards something that just looks like a red flag?
Um. So the only red flag that I've published is the word guaranteed, which was
Mm,
honestly shocking to me, Max. Like sometimes it comes from like what I would consider pretty either large or somewhat sophisticated sponsors, or I guess you can call them not sophisticated then, but I think you know what I mean. Like these are people running a few hundred million in assets, and they're pushing out a deck or an email saying, you get guaranteed returns of X. And of course, what they mean is they're highly likely, which can be based on a few bunch of different reasons, which is maybe a reason for another podcast. But my point is like, under no circumstances, in my opinion, is the word guaranteed not a red flag. There
mm.
just doesn't exist such a case. Um, so that's the biggest one. I think the second one that I'm like coming around to, I haven't published on this yet, but I'm curious to hear what you think. But I'm big on what I would call reasonable transparency, right? So there's a lot of sponsors that refuse to give certain information, right? So you might ask for a reporting package from another deal, and they'll just say, "No, I can't do that because I have like confidentiality issues." And my opinion on that is like, okay, so like have the LP sign an NDA, right? Um, or get on a call and video share the thing. Like
Right.
I don't know, like do something. Like I think it's a reasonable request. Like I'm not asking for your social, you know.
Yeah.
And I think it's important for LPs to understand how you will communicate with them going forward. And then similarly, like you'll ask on, the deck will say, hey, we have 20 years of experience, and sometimes also 20 years of combined experience, and then it's like how we've done a bunch of deals and we're great, and it's like, okay, can you show that to me with the property addresses and like when you bought it for how much and when did you sell it for how much? And they're like, oh, we don't disclose that information, but I'm happy to get on a call and give you a few examples. It's like, I don't know, like it's interesting because this whole space is like very opaque, Max, right?
Yeah.
And so I personally I get uneasy when like a GP on the front end, right, is not willing to provide very basic information. Like I've advised LPs on GPs that have been around for like 40 years in some case. You ask them for a track record, and a part of them is like probably like, oh, who is this person asking for a track record? Like that's so silly. But then they attach a PDF that has like 100 deals on it with every single stat on it, including some deals that didn't go over well. And it's like, well, that's great. Like at least I know who I'm talking to. And I think
Right.
naturally the LP feels a sense of transparency and professionalism, right? But I think for some reason, some of the newer GPs kind of feel that they need to keep those things close to their chest. I don't know.
Yeah. Well, you see, that's interesting. Like the not wanting to be transparent. That's always a red flag in deals. And sometimes you'll see, like if it's a sale of an asset, there's certain things they don't want to divulge to you. They know you're really serious. And maybe in this instance, it's like, hey, is this person the real deal or are they just trying to fish me for information? But it seems like a reasonable request. One thing that I've noticed is like it's hard to, and I've even actually struggled with this in like putting a deck together, like
Mhm.
to for the sponsor to really articulate why they're doing the raise, which sounds dumb, but sometimes it's like I've looked at a deal recently that was like a multifamily deal and it's like, well, wait a second, this was built in 17, it hasn't really performed. You've got all these other comps on here that are performing, and you're saying if we do these renovations or this, this new injection of capital, we can get the rent up to where these other comps are at. And I'm just kind of like, but it hasn't performed. I don't know. It just seemed like when I looked at in that deal specifically, the comps they were using had a bunch of things that if you didn't know the area, then you wouldn't have caught. Like, for example, all those others had parking garages. This one didn't. And that's kind of a big deal. Like, this is in kind of a higher crime area that's not, it's a up and coming area, but like just little things in there. And you like kind of read between the lines. I'm like, are you really trying to do upgrades to this apartment complex to, get the rents higher, or are you guys like in trouble and you're just trying to raise money? Like, I'm not clear. Like, you can tell me what the sources and uses are, but when I look at it on the face of it, it looks kind of like this is a struggling asset and you're trying to go get fresh money. I mean, it's just not always clear exactly what the motives are. I guess my point of that rant.
Yeah, and I think that's on the GP to provide. Like, I mean, meaning every investment has a story, and to the extent possible. Obviously, it's hard to tell a story over a PowerPoint to some degree, but you need to be able to communicate that story the best way you can. And I guess while we're on that topic, like I can't say that a lot of these decks that I see do a good job of that. In fact, I would say probably 90% don't. Like 90% of decks are literally just like, here's a picture of the apartment complex, and here's a pro forma, and your returns are going to be 2x, and you can reach out to us here.
Right.
Right? And it's like, well, okay, but like, what's the story, right? Like, why are you excited about this? And what's interesting, Max, is sometimes I think if you dig deep enough, sometimes GPs themselves don't necessarily know why they're excited
Mm,
about it. Like they push out a model and it looks okay, and they're just like, okay, renovate the rents and renovate the units, push up the rents, and then it's going to be great. But like, I think it's super important for that story to be there, and for the LP to understand it, because it also helps understanding like the mitigants and the risks on the deal.
for sure. I do think that's important, and it's hard to translate in a PowerPoint. But some of the
It
ones
is, yeah.
I've seen, I've noticed that as well, that they don't do a great job of it. The other thing I've noticed is like in a few of the presentations I've looked at, they will say things like, "Well, we're going to do a targeted distribution of 7%." And I remember looking at this deal and I'm like, so this isn't like a hard pref. This is like a soft pref where you kind of say we want to do this distribution of 7%. And at the time, I think the 10-year was like around 5%. And I'm like, okay, so I could get a 10-year treasury at 5 guaranteed pretty much by the government. But yet here you're saying, well, maybe there's a 7%. But like somebody who's not really thinking critically about it could just be like, I'm getting a guaranteed 7% like every year. Right. And so
Yeah,
it just can be
yeah, and in
deceiving
some
sometimes when you
cases
look at
they
these
won't even
terms.
say targeted; they'll say guaranteed. That was an earlier point.
Yeah. Like it's it's kind of tough. How does like the uncertainty around, if you like you mentioned cap rate earlier, if you look at the cap rates on some of these deals and where papers trading today, I mean like do some of these deals I've looked at, I'm kind of like, man, if interest rates go down, I think this thing could be interesting. But like in this current environment, it almost seems like some of these assets are just treading water. It's like they're just trying to bring capital in to sort of stay afloat. It's hard to know, I guess, my
I
point.
think that is the case many times. Like a lot of the syndications that I see just don't make, I guess what I would call like probabilistic sense. Like I don't think you should be investing based on macro events, right? Like that to me, that's sort of like macro investing, not real estate investing. Um, you can certainly bet on something and say like, look, if rates don't change or maybe they go up a little bit or to go down a little bit, I'm going to be okay, and it's going to be fine. And look, like if well, for whatever reason rates go down again, well then it just becomes a slam dunk and we'll high five each other. That's fine, But I do see quite a bit of deals that are making, like pretty aggressive refi assumptions in a year from now, perhaps even more aggressive exit assumptions 2 years from now or 3 years from now. And a lot of LPs just don't know how to catch that stuff. It's like, um, I always speak about this, but it's like, people are super obsessed with IRRs. And I think many of them will actually filter deals based on IRRs. Like they'll open up a deck and it'll say 12%. And they'll be like, oh, what? Like, I can like put my money into treasuries and get 5. So like I'm not even gonna look at this. And then the next one comes and it says 20, and they're like, okay, now I'm interested, right? But the problem is, unless you know your counterparty for years and you know like whether they're conservative or not, right? What you're sort of inadvertently doing is passing on the sponsors that could potentially be the conservative ones and starting to allocate to the ones that are pretty aggressive.
Yeah. Well, and then you start to look at like these financial models and understand, and I'm glad you brought some of this up, but like these different toggles that you can switch on and off or change like a slight tweak. Something as simple as the terminal value on, when they think they're going to exit or the timing of the
Yeah,
exit. And that can totally change the return profile. Or just like there's so many things in a financial model. It's kind of like garbage in, garbage out, but you can tweak just a few of the assumptions in there by not even that much. And it can make a pretty dramatic difference in the IRR. And so it's like if you don't know which one of those assumptions are the most critical, then how can you really even stress test or vet the actual model? I think that's tough for folks that aren't used to looking at those every day.
100%. Yeah, and as I always say, if you don't have time for that, I don't know. Many GPs don't like me saying this, but I don't think you should invest. I don't know.
Yeah,
That's just my take.
for sure. What do you think about like alignment and structure? And I've seen you comment on things like how much is the GP putting in the deal, and then you're like, okay, but yeah, but how much after the acquisition fees are they putting in, right? It's like, well, we're
Yeah.
putting in this much. It's like, yeah, but you're taking that from the fees and just putting it in, so it's not really your money. But talk about some of the other things that you see that could create misalignment, or the things you see that create good alignment.
Yeah. So I'm on alignment as far as the co-invest goes. What you're referring to, is sort of like the relationship between the co-invest dollars from the GP and the acquisition fee. Many times those are about around net zero, In other words, the acquisition fee is very close to the co-invest. In some cases, I've actually seen even worse. In other words, like the acquisition fee covers the co-invest and provides the GP with dollars. Um, and I think what you need to look for, all else equal, is like a place where the co-invest is larger than the acquisition fee, right? Now, the reason why I say all else equal is like, let's say you're talking to, I don't know, a 26-year-old, 25-year-old, a few years out, they found their first deal, they've got like, 50K in the bank, and they're like, look, I'm going to be super transparent with you, man. Like, this is my first deal. I kind of know what I'm doing, but I mostly don't know what I'm doing. And I'm going to give you a 90-10 split because I recognize the fact that I don't really know what I'm doing. And I'm going to put 50 grand, and I recognize that 50 grand is like barely enough to, to compare to the acquisition fee. But that's the deal. Like, what do you think? So at that point, like the conversation turns to the LP, and you have to understand like what your risk tolerance is, right? And whether the fact that you're getting better upside compensates for the fact that this person doesn't have experience, and in a good way is at least transparent about that. Many GPs aren't, right? So it's sort of like this balance, Max, that I think is really important. And I also, in terms of alignment, I'll get these questions from Twitter all the time. Someone DMs me and they're like, hey, I noticed the deck and it had 50-50 splits. Isn't that insane? And I can't answer those questions. I've just stopped answering them because the answer every single time is it depends, right? Like a 50-50 split over a zero with no co-invest, right, is not the same thing with compared to a 50-50 split with a 10% prev with a 25% co-invest. You get what I'm saying? Like,
Yeah.
um, it's complicated, right? And so I can't answer those questions other than saying all else equal, splits are typically 70 to 80%, with the remainder going to the GP. But like the all else equal part is pretty tricky, right? You need to understand like what can offset the fact that the profits are heavily weighted towards the GP, and whether you're comfortable with that or not.
Yeah. What are some of the structures you've been seeing? You talk a lot about private or pref equity, just other things going on that you're seeing trend wise around groups that maybe they're struggling. What are they trying to do right now? Are they going out? Are you seeing folks that are stressed and they're going and trying to cover that up? Are they being honest about the stress? Is it, the existing investors now getting subordinated by pref equity? I mean, what are some of the trends you're seeing?
I mean, in the world of distress, which is a subset of everything, obviously there's plenty of things that are healthy, but in the world of distress, I think the summary, Max, is it's just the Wild West, right? I would say by and large, LPs in those deals have no idea that their investment is distressed. I've said
Hmm.
this publicly, and I'm pretty sure it's true. Like, for every single investor that calls me and says my deal is worthless, what do I do? I think there's 10 people, at least, maybe more, that just have no idea that their investment on paper is gone, or is like severely impaired. Like, I think, and partially that's because they don't know what to ask and they don't know what to analyze. And I think partially that's because the GPs aren't necessarily forthcoming with some of that information. I see a ton of capital call requests that even then, like even when you need more money, you avoid like completely basic questions such as like how's the investment doing, what's the plan, like is this the only capital call you expect, or do you expect to have another one, you know so it's quite a world out there. I think in terms of solutions, you know pref is pretty common. um, in some cases modifications get done, and they get done pretty successfully actually, because depending on the relative leverage, not like debt leverage, but negotiation leverage between the GP and the lender. In some cases, like the lender in such a bad place that they have to sort of come to the table with something, to not get screwed themselves, which is interesting, right? Like if you look at assets that are worth significantly lower than the principal amount of debt, which happens quite a bit, like those tend to get like the best deals, right? Because if the lender can foreclose and get their money out, they're not going to play games, right? But they start playing games when their position isn't so secure.
Right. You always talk about the capital calls, and it's interesting to me because we're in the deals that we've worked with, or the deals that I've been a part of, there's like a commitment amount. And then once the commitment amount's done, are you talking? I mean, there's no capital. I mean, you're not really like going to go back to the well and be like, by the way, I know you committed $100,000, but I need another 50 grand from that person. Is like those the types of capital calls you're referring to, where it's like someone's already given the amount that they've committed and they're coming back and asking for more? Or is it, I mean, how does that work? I guess they're just going to their LPs and being like, hey, we need more money, essentially.
Yeah, so generally speaking, there's two types of capital calls. Ones that are expected, like I don't know, you have a construction project and you told your LPs
Right.
like we're going to draw 50% now, 50% in a few months. Or another famous one is a fund where there will be like capital calls throughout the fund cycle because they don't need all the money right now. Um, what I'm talking about is unexpected capital calls, which are not
Yeah.
those two, and those look exactly as you've described, Max. It's you get an I mean, either on unexpected in the sense that you literally had no idea that it was coming, or unexpected in that perhaps they've been communicating that there are challenges, but when you invested, you thought you fully capitalized this deal and you will never put another dime in again, right? So in those circumstances, the LPs will get a notice and it'll say, "Look, like here's what's happening, and we need money, and the only way to bridge the gap seems to be your money. So you can either put up more money, or we're going to lose the property."
Yeah. Seems like communication is an issue, and not just in real estate investment, but I've done some like venture capital kind of investments, not luckily not large dollars because most of them have not really done all that well. But I mean, they've done okay, but they're not like, they're not like rock stars. And I've noticed that like, especially from founders or managers that don't have a lot of experience, it's like they just kind of seem to bury the bad news. I'm like, hit me with it first, guys. Like, I don't want to go through like a 30-page deck of you telling me how awesome everything is. And at the very end, you're like, by the way, we're out of money. You know what I mean? It's like, I think, do you feel like communication is a problem with these GPs? They just don't know how to like get the messaging right.
I mean, obviously, this is broad strokes, but if you're talking about retail GPs, then by and large, retail GPs that have challenges, then by and large, at least from my sample size, the answer is a definite yes. Um, I see a ton of reporting packages that, I mean, I joke around it on Twitter, but it's like there's like pages of pictures of like new dog parks and like the new electric charging dock that they put in for Tesla, and their like Thanksgiving party. And then on the last page, number 25, they're like, "Oh, by the way, we expect to lose all of your money." And it's like, whoa, like,
Yeah.
what? Like, tell me more about that. And what are we doing about that?
Yeah. It's like none of that other
Um,
stuff really matters, right? Like, just that should be
right,
the only
right.
thing we should be talking about is this.
Yeah. And it's interesting because I think part of that is maybe LPs are to blame a little bit in a sense because there's been this like obsession with reporting. Like you have to report monthly or weekly in some cases I've even seen. And it's like you need to let the GP do their job, right? And ideal communication comes whenever it comes, with important stuff, not like irrelevant stuff. And when you sort of put yourself on a timer, on the in some sense it's good because it creates sort of some timelines and expectations. But I think in another sense it's very bad because people just fish for like anything to tell the LP that otherwise is kind of not so relevant or important.
Yeah. Well, I think being like what I've learned is that being an investor in different either companies or projects, and then seeing the communication from the either GP or manager, whatever you want to call them, the owner, it's helped me, I feel like, be better at understanding what you should do if you're in that seat, because you, as someone who reads them, you're kind of like the example I gave you earlier. I'm like, you know what I really care about? I really care about like sources and uses. Like, what's our cash flow look like? Like, yeah, this these pro forma, this projection's great, but like, show me like how much money's going in, how much money's
Mhm.
coming out, and give it to
Yeah.
me by month. And sometimes it's just like these things that I feel like as an investor, it be like kind of how like I run my personal finances. It's like I want to know how much money I'm making every month, how much money I'm spending, what that looks like. And you'll look at some of these updates or decks and you're like, I don't get any real sense of how the business is actually doing with what I'm reading right now. And so I
Yeah.
think that's helped shape my perspective on what a good update or what a good communication should look like.
Yeah.
But I don't know if you're seeing any of that stuff too. Are people sending you like,
Same thing. Same thing.
yeah, yeah, you're seeing something similar? Are they? Do you have clients that are sending you stuff? I guess like you mentioned earlier that they're in the middle of a deal right now that they've been in for a while, and they're like, "I'm getting this from the GP. Like, this doesn't seem right. Like, what are your thoughts here? Like, you're getting updates from or advice, giving
Yeah.
advice to
Yeah.
folks like
All the
mid
time.
deal."
Oh yeah, all
Yeah,
the time. And so I would say probably 80% of that is like they have a decision to make, right? They like have a capital call decision, or perhaps they have like an option to get bought out, and they're trying to figure out whether they should take it or not. Um, but 20% is probably just like, hey, I haven't heard from my GP in a year. Like, is that bad? Is that concerning? Like, what do I do? What are my rights? And, I'm not an attorney, but like, there's certain things that you can do and just can't do in general. There's, just some certain things that I can help with in terms of trying to figure out the options that are available to them.
right. What about just like any interesting stories of like crazy things you've seen, or even just like overt scams or things that you're like, this looks unlawful what they're trying to do? I mean, just anything you come across that's just egregious.
Um, I mean, one thing I've seen is that LPs, and this makes sense. Obviously, when you lose money, you tend to over exaggerate your thoughts, right? Meaning, I'll get calls probably once a week that goes something like, "I'm pretty sure this GP is a fraud," or like, "You defrauded me," and then you start looking into the details, and the details are pretty sad, and the money is probably lost. But the reality is like they just invested into something, and perhaps had bridge debt, and then the rate cap expired, and now the asset is worth 30% less, and there's just no way out, basically, right? Um, but yeah, I mean, I see a lot of stuff like that. I don't know if I've seen any like outright fraud. I've seen quite a bit of cases, Max, of I guess you could call it like deceiving activity. Like saying one thing but doing another thing. You say that you're going to close on a fixed loan, and then you close on a floating loan, and don't notify anyone. Um, Maybe you insert a pref before closing. Maybe um, you suspected that you would raise X, but then you end up raising a lot more, and you've been paying distributions from the money that you raised as opposed to the property,
Mm,
which surprises everyone. There's a lot of these, like, I guess you could call them like small things, um, but those small things can make a really big difference in terms of understanding who you're dealing with.
yeah. What asset classes are you typically are coming across your desk? Is it everything? Mostly multifamily,
I've
mostly,
seen
or is it across
everything.
the
Yeah,
board?
I've seen everything. I think because if you aggregate the dollars that went into multifamily by transaction number or investment quantity, I think my hunch is like 80% of retail money went to multifamily, right? I'm just making that number up, but I think it's pretty big. And so because of that, I think a lot of people either come to me on multifamily existing investments or future ones. But I'm seeing, a ton of industrial, RV parks, industrial outdoor storage, office in some cases, hospitality. Like I've basically, I don't know if there's an asset class that I haven't seen.
Yeah. When it
And I
comes to the
also
stress,
I also do
go
quite
ahead.
a bit of like stuff outside of real estate too. Like I reviewed an oil and gas deck the other week, and I
Oh
mean
yeah.
that might be up your alley. Oh man, it was the Wild West.
Yeah. I got a good reservoir engineer you can talk to. He's good at picking those apart. A
Nice.
buddy of
Okay.
mine. Any like, do you think the stresses, have you noticed it being concentrated in one asset class or another? Or is it just kind of like, uh, events or like just specific to
Well, again,
whichever
I think
deal
it's
it
kind of
is?
like a sample question, right? My sample is like very heavy multifamily, but I think
Hmm.
it makes sense because the population is very heavy multifamily, right? In terms of like how many people invested in those things. Um, and so what percentage of the distress that I see is multifamily? A pretty high percentage, but I also think that makes sense. Meaning, I don't think that necessarily means that um, multifamily assets are worse than others. It just means that more people went into them, and more people are reaching out to me because of it.
Yeah, for sure. Well, we're getting close on time. I know you got a hard stop, but one set of questions I did want to ask was,
Yeah,
how does it feel? Like I've seen some of your tweets around just the entrepreneurship thing and being on your own, and you've said some stuff that I really resonates with me, just like all the little nuances of having to, forge your own path and tackle all the things that you have to tackle, that I think a lot of people view it as like, oh, it's really glamorous. You're doing your own thing, when that there's like a lot of aspects that are just kind of like gritty a little bit.
yeah.
But just how's it been, doing your own thing?
I think I'll summarize with my wife and I went to like a class recently, and I asked her like, how was it like starting your own business? And she's like, well, if I may say it, it's basically like running outside naked. And I thought it was so funny, but so true. I'm saying, Max, it's crazy. I don't know. Like I also say usually it's really high highs, but really low lows, right? Because everything is
Yeah,
personal. So I think that goes for the positives and the negatives. It's been pretty rewarding. It's been pretty stressful. It's been nothing like I expected when I was at a W two. Um, you know, it's um, it's way more complex than I ever thought it would be, and
for sure.
it's definitely not for everyone.
I'm proud of you for doing it. I think it's good. I mean, at the worst case, you learn, you make some money. If you don't want to do it forever, you can go back. I think there's plenty of people that want to do something and they don't end up doing it, maybe have some regrets. And I've seen the power of how it can lead to great things. I think you're doing good work too. I think like what you're doing is a valuable service to folks, and for people that would want to get in contact with you. What are the best ways?
Yeah, so my name is pretty unique. You can find me on Twitter or X and LinkedIn. I post there every day. And then I also write twice a week at lplessons.co.
Awesome. Well, I would love to catch up with you off the record too, because I think it's really interesting. I'm sure you got maybe even more stories that you might not want to share publicly, but I'll be following along. And also,
Yeah.
yeah, I forgot to one other question here. We got 1 minute left, but you're doing like a podcast now too, right?
I started, yeah, it's a very, um, I guess I would call it like an unprofessional podcast. as you can
I don't know if
tell, like,
there's such a
I'm
thing as
starting
that.
to sort of like, revolutionize myself. I'm also trying to figure out whether I should keep it like only on Substack or put it on other platforms. It's like so many questions that you have to figure out as a business owner, and I think sometimes you just have to do it and see what happens. So that I think that's where I'm at.
Well, keep it up, man. The podcast stuff can be a lot of work, but it's also rewarding.
Yeah,
And I'm glad we got to do it. Thanks for coming on. I appreciate it.
yeah. Thank you so much. I appreciate you having me on.
All right, thanks, guys.